I've been full-time trading for way over 10 years now, consistently profitable with specific type of setups. I would call them high probability, low risk. But what I'm really referring to is the bread and butter, the things that take care of business. You don't just become consistently profitable by finding high probability setups. You do this by learning how to trim the fat of the low quality trades. In this video, I'm going to share with you how you can find high quality setups, what to look out for, where the noise is, and how you can avoid these low quality setups, and how I have consistently been finding high quality trades. So I'm just going to get straight into this concept, and if you pay attention, you're going to be able to frame your trades for high probability setups so much better. So let's take a look at this. Your job is to understand this concept and what you can do after this to build an actual strategy. We have a strategy that we trade. It's predominantly with the higher time frames. What I'm going to show you is a concept that is more isolated. So how you add more of an edge towards this is building a high time frame narrative. But I want to isolate it for you so you understand what we're looking for, and then you'll realize the clue is right there, which is you'll understand where your noisy trades are and where you're just taking unnecessary losses. So if you look at this on EuroCAD, so this is a trade that I'm out now for 4-1, lovely 4% trade. Now if you looked at it at first glance, let's say we zoom out to the 1 hour time frame, you could see it as just a bit of sideways price action unless you knew what was happening within here. Now if we take this piece of price and study that, that can be quite choppy, quite messy until you know the small intricacies. So let's look at the behavior. This is the concept that I want to share with you. So what you're going to find is your high probability setups will come with the higher strike rate where there's volume. So I want to mark on the volume that I'm interested in first. So the highs, the lows, and you might think, oh, well, Mark, that's easy. You know, just a break of high, a break of low. That's not the first time I've heard that before. Of course you haven't. But what is right under your nose, a reoccurring pattern right here that you would just maybe ignore, because what you're probably interested in is, I'm waiting for a high to be swept, I'm waiting for something to break the low or whatever. What you might not be looking at is this, the gap before the break. Now the gap right here. So if we take this concept and think about bread and butter trades and now look at the noise is right here. The noise is areas that it technically has liquidity. There is volume there, but it's not where the main move usually goes. So it's in areas like this where there's an unfulfilled gap either side. Now either side is key. So if you take this frame and go, right, if I've got an isolated setup where I've got a gap to be filled to the high and I've got an unfulfilled gap at the low. So if we say here is our, call it major volume, right? Just for argument's sake, we have major volume right here and major volume here. So these are going to be our best areas. These are our high probability setups. Now when you've got a profile like this where you have a gap for a high to be filled and you have a low for a low to be filled, and then either one gets taken out. So let's say, for example, on the flip side, price was here and you've got a gap to the high to be filled up here, but we've not filled that high yet, and you've got this low to be filled. Price action could have come down like this, filled this gap, taken out this low, and then I would have got long on this structure. What just so happened is that we done the opposite. We took out the high and we had our rejection. This is on the 15-minute. You can scale it down to the 5-minute in certain scenarios. But this framing right here, if you understand what I've just taught you in like a couple of minutes, you can build high quality setups just off of that. Why? Because the traps are in the gaps. The traps are going to happen where you think the trade is going to go in areas like this. So you might be wondering, well, how do people get sucked into that so easy when it's so easy to just zoom out, identify where the more significant volume, which I refer to as major volume, you can see where it is. Why would you trade in between? That's because people can't help themselves. That's because people are emotional. But the other side of it is this. Let's say we scale into the 5 and we could go even lower. What you're seeing is the chart blown up like this. We move this across. You're seeing this as an area of significance. Let's get an arrow in. This will be easier to show. So you're seeing it like that. So trades are happening right here. and people are selling, thinking, right, this is the trade, comes back up, they got a tight stop, tagged out for a loss, boom, they try and get in again, then they leave their risk open, they're like, right, it's a re-entry, so I'll get back in again, boom, taken out again, they don't move it to break even. So they take 2 hours, right? They're -2 at this point. The trap is so obvious, it happens right here. Meanwhile, I've zoomed out, I've prepped this trade ahead of time, I've seen where the significant volume is, I don't need to chase the market, I actually wait for all of these amateur moves, that I would call them, to play out, and then once they've been filled, just like this. And how would we know that this is more likely to be filled? Well, it's pretty obvious. If we start looking at the major volume in a bit more detail, and I'm getting intricate here, is here, you have an unfulfilled gap. So what's the chances that this was going to go here? Any trade would have been temporary. So you could sell it, yep, it has a lot more risk attached to it. This is where I would encourage a lot of our traders that trade the way that we trade. Yeah, you're more aggressive with this. You know, if this starts turning around really quickly, this is like a manual close. You take a quick, very, very small loss or a break even if you're lucky, and then you wait, because sometimes these trades go. But more often than not, when you've got the clues, the unfulfilled gaps, they get filled, they get wicked out, and then we go off to the races. And this is a beautiful, beautiful trade. What you could have done as well is, if you didn't want to hold for the bigger structure, I had more of a higher time frame narrative with this trade. If you didn't want to hold for that, you could have just exited here. That would have also been appropriate. Now, we did have some news volatility, but forget about that for a moment, because that didn't frame the trade. That was just the after effect of it. These are repeatable setups, but they only add more value when they are built with a higher time frame narrative. When you look at the concept in isolation, I want you to understand the concept as to why these trades are so valuable and why they gravitate towards those directions once the highs or the lows are getting taken out. But unless you're building the higher time frame and you don't know what you're doing, you could take a lot of losses if you don't understand how to build this correctly. I'm giving you something to work with. If maybe you're a new trader, you've got no idea of trading, I've just helped you avoid loads of losses just by zooming out and focusing more on where is the significant volume versus just noisy areas where I'm taking a lot of my losses. Maybe even just by watching this, you could look through your trades. If you're someone who's more lower time frame based at the moment, you probably can just spot your losses already. Like, I'll give you the same concept. That's cleaner, I would say. Let's look in the same piece of price action, and let's look here. So remember what I taught you, unfulfilled gaps to the lows and to the highs. So let's frame it exactly the same way. I use arrows. So if we go here and we mark this on for the low, and let's take it the same way. So if I zoom in based off the exact concept that I just showed you, what do we have? We've got our significant volume here, our significant volume here. What do we have again? We have our gap from this low to this low, and we have our gaps in price here where we haven't tapped or broken above and taken out where there's more significant volume, have we? But what do? We break it, we take it out, we come back in, and then we start to enter into the shorts. So you'd have your stop cropped through the wick or above the high. That's a video for another day, but I'm just giving you potential entry points. So let's say you're in, whether you've gone slightly wider on your stop loss or you've gone a little bit tighter, you're in the trade, and what you're looking for price to do to roll over to fulfill the unfulfilled gap, because we've already filled the first gap at the high, and then we're looking for the low to be taken out. Nice and simple. So this would be a trade like this. So you'd be in roughly here, and your stop is either going to be 20 pip stop or it's going to be closer to a 15 pip stop. And then your target is either going to be here for a 5-to-1 or it's going to be the actual low of the gap. So that would be 4.4. Simple concept. This is exactly the same thing. Everything in between with large volatility wicks like this, that's just noise. That's not really a tradable structure there. That is mess. Where if you were just fixated on, let's say, EuroCAD, and you was only trading EuroCAD, yeah, you'd make mistakes in here. But I can walk away from that and look at a different pair that has a repeatable setup. Now, the reason why these trades are valuable, albeit if I was to grade it, this one here is much higher quality than this one, that's fine. But you've got to look at the reasoning as to, does this trade have a higher time frame reasoning for the market to continue to sell off? Or am I trying to get involved in selling opportunities that is a buy zone for much bigger players in the market? That's a question for you, and you have to be able to answer these questions for your strategy. Now, I haven't even gone to the daily yet. I haven't even gone to the weekly, so you can understand where we're actually positioned in the market. I'm only showing you the concept on the lower time frame, that if you get this right, and a lot of your trades within the system that you've got has this makeup of highs and lows being taken out. But I don't mean the lows that you think, because you might be referring to lows on the day or the previous session or whatever the system that you've got. I'm talking about, forget the previous session, forget the last day. I'm talking about marking on where the significant volume is. The significant volume is always going to be where the significant volume is. It's not going to be the previous day or 2 days before. It's going to be where it is. And you can easily see that from the previous gaps to the highs or to the lows. So this one here was on Monday, right? And as you can see here, on Thursday, it takes it out. It wasn't the next day, was it? Right? So it took a little bit of a while. This one was on Monday, but this one happened the next day. So you can see sometimes it's going to be the next day, sometimes it's going to be 2 days later, sometimes 4 days later. But it doesn't change the fact that the significant volume was exactly where it was supposed to be. The low was marked on, the high was marked on. It's so simple. Now you might be thinking, well, can I just apply this every single time? Not necessarily, because the market is not always going to be moving sideways. Sometimes it's trending and it's more aggressive. Sometimes it's moving sideways like this. That's why you need a whole strategy. But this concept alone will keep you out of so many bullshit losses and keep your focus on where is the high probability. Whereas high probability, lower in risk, that is what is going to move me towards being profitable. So if you're a new trader or a confused trader, this definitely gives you something to work with. Hopefully you can now see where you've been going wrong. Now, I've not even got into the details as to why traders lose, and this can be variations like people just cut their winners short. Again, that's a video for a different day. There are levels and layers to this, but I want to give you something simple, a really simple concept that can be applied to most systems. And if you get this right and you stop all of the nonsense in between, you will move towards profitability. Your image of what you think a profitable trader is so crucial to this. So for example, I've spoken to many traders over the years, and what I've come to realize is that most people don't recognize that unprofitable traders and profitable traders take the same profitable trades. The only difference between the ones that become profitable or not are the ones that can remove and trim the fat, as I was alluding to earlier. So when you can really grapple with that and realize, right, so these profitable traders and people that are not profitable, they still take very similar high quality trades. Even the ones that are unprofitable, the unprofitable traders are not terrible traders. They're just in drawdown, or they're not winning is because what they do in between is all of these noisy trades. And the only way they become profitable is learning what the noisy trades are, how to avoid them, emotional control so they don't keep repeating the same loop, they stop gambling, and before you know it, they're closer and closer towards being profitable. It's fine margins.